Hey guys, welcome back. In this video, we are talking about what the shorts are hiding, exposing the books, the buyout offers, and many more in this video. First, we're taking a look at this. 30.9 million shares traded, 22.7 hidden off exchange, price barely moved. So when we take a look at the dark pool usage for AMC, what we saw for Friday was that it was 73.36%. Now, we've always looked at off exchange. We've talked about how internalization is obviously harming the price of AMC as it doesn't allow real price discovery for AMC. But there is much more to that because the point of dark pool and off exchange ATS, the high utilization is a giveaway that something massive is happening under the surface. These systems were originally designed to reduce market impact on a stock to the downside. Recently, these systems have been abused to reduce upside impact. There is zero order book impact until execution of the total order is completed. This is why you will see a massive volume bar with neutral impact frequently. Dark pools exist mainly to let big institutions move massive amounts of stock quietly without shaking the entire market. And so we've talked about obviously how dark pool has been used to reduce upside impact. We've seen the suppression, we've seen the manipulation, but not only that, it's also talking about what is the actual volume doing? What are they actually doing behind the scenes for the fact they need to use so much dark pool? What's going on? What are they hiding? And so we've already seen with the institutional ownership is that one big reason for why we are seeing this is because institutions all realize the opportunities and potential of AMC. Hence why we've been seeing the institutional ownership increasing drastically. And now the thing that they want to make sure happens is the fact that they can buy as much AMC shares as possible without the retail realizing how good of an opportunity that is. And so the way for them to do that is buy up as many as possible without affecting the price. And then in the media, talk about how AMC is actually a bad stock, why you should actually sell your AMC shares. And then they're continuously buying up the shares being sold by retail, again, quietly, so that it doesn't give off the look that it is a very good investment. And so this is something that we have to understand. Another big thing is that if AMC sits below $2 for a prolonged time, we will likely see more spikes in SI, along with it the cost to borrow. I know AMC will raise capital, but at the same time, the daily buying needs to be countered to keep price low, and that costs tons of shares. So we know about how AMC wants to raise cash. This is something that they've already talked about. We've had the whole agreement in terms of the stakeholders voting, etc., etc. Now, a big thing we talked about is AMC has an insanely good ability to raise money because the apes obviously support it, the retail, the mass stakeholders obviously support this. Now, the shorts realize this as well, and they realize they can't prevent AMC from raising cash. However, they can prevent AMC from raising as much cash as possible. When AMC was in the hundreds and they wanted to do a cash raise, we voted against it, or at least the general consensus was that it was a no. And we stripped AMC of the ability to raise cash to be in a position like GME is. We've always made the comparison between AMC and GME, talking about how the reason why GME has billions of dollars of cash was because at their highs, they were able to raise cash, but AMC wasn't. And they've realized that because of the fact that GME had so much cash, that's the reason why GME is able to still survive until now. It's the reason why GME is able to make these investments. It's why GME is able to expand. And so they've realized how powerful it can be. So now, as they see AMC wanting to raise cash again, the only thing they can do is to prevent AMC's price from going high. I'm sure anyone will understand this because if AMC wanted to raise $100 million at $2 for the share price, they will obviously have to sell more shares. But if AMC was at $50 and they wanted to raise $100 million, then AMC has the ability to obviously sell less shares and still reach that price. And so they want to dilute AMC. They want AMC to sell as much shares because they are in need of AMC shares. But they also, in the meantime, want to prevent AMC from the ability to raise as much cash as possible because they know that if AMC were to have that cash, they are able to do so much more. And if you want to see another example of manipulation, you can see the NYSE has fined Credit Suisse for allowing manipulative trading practices such as front running, layering, and spoofing for over 7 years. The now defunct bank has been fined 52 times since 2005, exceeding $12 billion in penalties. That's an average of $600 million per year. And so firstly, we have to realize is that spoofing is something that is finable. It is an offense. And it's why we've talked about when we constantly see spoofing on AMC, some people regard it as a normal thing, as that shouldn't be something that should be talked about. But you have to realize that this is a violation, and this is something that firms abuse to manipulate a trade, to manipulate a stock. Now, not only that is the fact we've seen that. Notice how all of this comes after they were transferred to UBS, likely found by UBS when looking through the books. If it took UBS to report it, who else is doing this completely unnoticed? So we have to realize is that, again, this has only come out after UBS are clearing through their books. And bear in mind, there are still a lot of documents that have been locked up yet to be released. And so this is so far what we are seeing. And so there's two things that goes about this, which is firstly, who else is doing this completely unnoticed? We've already seen firms being fined before. We've seen firms like Citadel. We've seen firms like Virtue, Goldman Sachs, all of these massive institutions doing it. But, who else is going unnoticed? But more importantly is how much is going unnoticed, because they are being fined for things that happened years ago that is only being found out now. So what are things that are currently ongoing that's being hidden? And another thing to realize is the fact that this was an average of $600 million per year. Now, bear in mind that you have to realize that they were doing this consistently. They were paying these fines consistently. Now, if they were willing to be paying $600 million per year, if they were okay with paying $600 million per year to a $12 billion in total, just think about how much money they were making for them to be able to justify paying this much money. So if you want to see how much money has been robbed from us, how much money has been taken from the retail investors, this is what we're looking at. This is from one institution who has already paid $12 billion in penalties. God knows how much they made in return by doing so. And then you account for all of these other institutions that we've mentioned in the past, you truly realize how big this number gets. You can even see here, market makers are paying $4.9 billion a year for payment for order flow. So this is what we're looking at. We're seeing firms like Citadel paying this much. And once again, it's the cost of business. Anyone who has a basic understanding, or anyone who runs their own business, if you're willing to be paying this much money, it only means that you're making more than what you're paying. Otherwise, you wouldn't be doing so. You wouldn't be paying $4.9 billion if you weren't making tens of billions, 20s of billions of dollars in return. If it's not a profitable decision, you wouldn't be doing it. Just like what we've seen in the past before, Citadel were originally against payment for order flows because they talk about how internalizations of trades actually damages the price. But yet now they're willing to be paying $4.9 billion. It just goes to show how they are able to manipulate it, how they are able to make money from this, but the manipulation and suppression that's ongoing in this market. You can see, let's make a bet. If Citadel were to use no dark pool on AMC for a day, they couldn't keep the price down below 10%. Because if they were so right about AMC, why did they feel the need to internalize 90% of the order flow and much more? And so this is what we've seen, and we looked at this before as well. Every time there has been a collateral problem, a liquidity problem, a dark pool problem, essentially anything that stops the short sellers from manipulating and suppressing AMC, we always saw the stock prices run. We've always seen how AMC was able to go up. And so this just goes on to talk about if we were able to see no manipulation, no suppression, just for even a day on AMC, we would easily see a 10%. We would easily, in my opinion, see a 50% and even higher because of everything that's obviously going on. And now you have to realize GameStop exposed the fraud, AMC confirmed it, and MMTLP proved regulators chose to halt the law instead of enforce it, making this a continued criminal conspiracy, not a closed chapter. And by now, I'm sure you have all seen it. AMC has confirmed multiple manipulation, wherever we're talking about the dark pool, wherever we're talking about the payment for order flows, whether we're talking about the front running, layering, and spoofing, all of these things have been proven, not just by AMC, of course, but AMC has definitely been a victim of all of these things happening. And then on top of that, what we're looking at is Binomial, which is a derivative exchange plus clearinghouse that offers digital asset margin to institutions. So you no longer have to report certain bounded swap contracts. Now, this is something that needs to be talked about. We have always seen how short sellers have been struggling for collaterals, for liquidity, and mainly for their swap contracts. We talked about the swap baskets. We talked about it for all of these firms. One of the ones who's infamous is obviously UBS with their toxic swaps of AMC and GME that they inherited from Credit Suisse. And now what we're seeing is how a clearinghouse plus exchange that is being introduced to make sure that people can no longer report certain bounded swap contracts. So if you want a proof of how regulations are helping these short sellers, this is what we're looking at. Once again, this is something that needs to be talked about. And then just like what we said earlier with how AMC is confirming all of the manipulation, you can see for NVIDIA, GME, and other Robinhood display users, what users are doing along with insiders their hedge funds. For AMC, however, the data is hidden. Along with the removal of 24/5 trading, bankruptcy label, misreporting of market cap, and buying SegTech 24 hours after use, removing the ability to buy. I can say Robinhood has a long history of messing with this company. So we've seen market makers, we've seen these institutions, we're looking at these brokers as well right now. This is the suppression that we AMC go through on a daily. So if you want to wonder why it's been such a difficult journey, but also how we're suppressing and fighting back against the suppression, this is exactly what's been going on. And then, in case you missed it, silver price is going up, gold price is going up, Sprott shares owned going up, other true shares owned going up, retail apes with diamond hand shares owned going up. So where will short sellers find 4.16 million shares when a buyout offer materializes? So we have to realize is that right now, HYMC is going up, especially with how the silver market is doing. I made a video on silver if you guys want to go check it out for yourself. And we'll talk about how this is going to lead to HYMC going up as well. And now because of this, when we do see something major happen to HYMC, like a buyout or any other things, these short sellers are going to struggle, meaning that HYMC is going to go up even further. The people who are going to benefit will be people like the apes, will be people like AMC. And when apes benefit off of this, it's very likely they're going to move the profit from HYMC into AMC, causing more liquidity, forcing more pressure on the short sellers. And then when it's AMC, if they're able to make so much money from this, you can obviously imagine that firstly, they will sell less shares. So for the people who are worried about dilution, this is obviously very good news. But secondly, with the cash they make, they are able to make more investment. They are able to do more things that allows AMC to grow. On top of allowing AMC to grow, going into the late 2026, we have so many good food movies coming out. And, I can only imagine that the Q4 is going to be another insane Q4. Not to say that Q1, Q2, Q3 isn't going to be good, but just like how we've seen this year's Q4, we're going to be looking at something else of similar and potentially even bigger for next year's Q4, which is obviously very good in terms of long term. Furthermore, China is about to leave high-frequency trading like Citadel, High, and Dry. What we're looking at is how China clamps down on high-speed traders, removing data servers. So this is obviously very good news in terms of the fact that firstly, we're seeing regulation and how they can actually able to do something. We only need to see the US obviously follow behind it. I don't want to make this political to bring it against US or China, but it's talking about how we've seen countless times in other regions, regulators have been able to stop these high frequency trading algorithms, to stop the negative short selling. Yet in the US, we are not able to see that. And so this is something that we want to see them follow. But you're also going to be looking at how Citadel is going to be taking a hit. We've already seen the hits they've took in South Korea. Now we're going to see them take hits in China as well. So then you're going to be looking at a decrease in the revenue that they can make. Another thing that we have to pay attention to is the Japanese intervention, where we're looking at how the Bank of Japan wrap up the week with the last touch of liquidity intervention with 237 billion Japanese yen. And we've talked about this in terms of the more intervention we see, the bigger the hole becomes. The very fact that they have to intervene is just showing how something's going on. And if we're seeing the Japanese yen crumble, we're going to be seeing the US market crumble. We're going to be seeing all of these overinflated market to all come crumbling down. And that will be a massive problem for the institutions. And if you want to see another talk about how they're worried about, the overinflation, the values, firstly, TSMCO sees 56% or higher growth margins in the medium term. Now, this is obviously very good news. It's showing about the market, at least for, the AI accelerators. But one thing that they've mentioned that they didn't go into detail, that the company is investing carefully to avoid a big disaster. So the investments they are making is obviously into production and obviously into the AI sector. And if they're talking about avoiding a big disaster, it obviously shows how they're worried about things that will happen, about the overinflation, about the market crash. And so for TSMC to obviously talk about this is something that we should be wary as well, is why I said the Japanese yen market has a massive theme. Not only is Bank of Japan intervening, we're also looking at how UK banks are facing a liquidity problem. So right now, UK and Japan is seeing massive problem in liquidity issues, as we see them borrow a record £99 billion of liquidity from the Bank of England. So if you want to see, are there signs of problems? Are there signs of illiquidity? Yes, there are. And this is what we're looking at, UK and Japan, with Japan being very important because of the carry trade. And then finally, US commercial mortgage debt climbs towards 5 trillion. We've already talked about this. We talked about the commercial real estate. We talked about how it's a worrying problem. And this is just what we're looking at. As always, this is F Financial Advisor. Do take advice, take your own salt. Make sure to do your own due diligence and research. And I'll catch you guys next time.